You will be subject to taxation on the amount that you withdraw, and as well, it will of course reduce some of the money that you have saved for retirement. But as long as you meet these qualifications, you may certainly take advantage of that option. All right, so that was a lot of information in a short time, but that is the hybrid plan in a nutshell. Obviously, this is a high level explanation of what it is, but I encourage you to go to our public website at npers.in.gov or in.gov/npers, and you can actually get all the specific details just by looking at the handbooks of each of our plans. Same with the My Choice that we're about to go over. So more specific detail is provided for you there, and I encourage you to check it out, as well as take advantage of all the other resources on our website as well. Okay, let me tell you about the next plan. This is the My Choice plan. Again, this plan is newer to the state of Indiana. It was started in 2013 for new hires as well as rehires. Have the choice to participate in this plan or the hybrid plan that we just talked about. Within 60 days, new employees choose which plan they want to participate in. And if they don't choose a plan, they default to the hybrid plan, the one that we just talked about. Okay? So if you want the My Choice plan, you would have to actively go in and choose it. And so let me give you some details about it. So it is a defined contribution only account. It does not have a pension. It is a 401(a) savings account. The contributions are fully funded by the state on your behalf, just like with the hybrid plan. The member controls the investment allocation as well as personalizes the beneficiaries. Okay? No loans or hardship withdrawals are available from it while you're working. It has two types of contributions that are made to it. Again, both are fully funded by the state. So the state puts in 3% of your salary as a mandatory contribution. They do that each pay period. That's a fixed contribution, so it will always be 3%. Then there is a variable rate contribution, and the state also fully funds this. The variable rate can change annually. The current rate is 4.2% of salary that's contributed to this each pay period. Now, with the variable rate contribution, you have to work a certain number of years before you're the full owner of those contributions. So this is how it works. With the My Choice plan, you vest over a 5-year period. So for each year, you own 20% more of those contributions. So at the end of 5 years, you fully own all of those contributions and any subsequent ones. So you're building a balance over time of those contributions as well as their investment experience, so that at retirement you have an amount of cash there that you get to determine how you'd like to receive in the way of a retirement benefit. But you fully vest at 5 years. At retirement, you've got choices just like you do with the defined contribution account of the hybrid plan. Same choices. You can choose to purchase a lifetime annuity so that it pays you monthly for the rest of your lifetime. You can take a lump sum withdraw the entire amount or in partial amounts. Again, taxes are immediately withheld of 20%. And then you pay ordinary income taxes as time goes on. You can roll the money over to another qualified plan like Hoosier Start or a qualified plan at another organization. You can also do a systematic withdrawal where you dictate how much you'd like to receive over a period of time and have the opportunity to change that as you need to. So it's very flexible. You're not limited to just one way to pay it out. You can choose multiple different ways for different amounts of money in your balance. So that's the My Choice plan. But in addition to this, those that participate in this plan also have the opportunity to withdraw from it while still working. As long as you are vested in at least age 62, you could also do an in-service withdrawal from this plan while you're still working. Just know that, again, taxes will be due as well. It will reduce your retirement savings balance when you do that. But it is an opportunity that you have. All right. regardless of which plan you are in, the hybrid or the My Choice. These are your investment choices. They're the same regardless of which plan you're in, and you control your investment choices. Okay, so we encourage you to build your asset allocation. These are all the funds that are available to you. If you look at the very bottom, there's the target date funds, and these are pre-built asset allocation portfolios that are available for you to invest your contributions in, and they're made up of all those funds that are listed above it. The nice thing about a target date fund is that it changes for you. You don't have to actively move it, so that as time goes on, it becomes a more conservative investment as you get closer to retirement. So all those shifts are made for you so that it's poised for growth in your earlier years and becomes more conservative the closer that you are to retirement. So target date, the date is based upon when you may retire at 65. You can always change from a target date fund to another fund and build your own asset allocation. The target date funds are the default. So if you haven't chosen an asset allocation of your own, you would default to a target date fund. But again, you can always change these, okay, at myempressretirement.org. All right, in addition, regardless of which plan you're in, hybrid or My Choice, you can make voluntary contributions on an after-tax basis. You can contribute up to 10% of gross wages that would be contributed to your defined contribution account. So that's purely voluntary, but Kim will certainly talk to you about a pre-tax savings opportunities through Hoosier Start in a moment so that she can give you all of those details. And that's actually right here. So I'll turn it over to Kim in case you need it.
Good morning still. Excuse me. It's a pleasure to be here. As Lisa mentioned, I'm Kim Rumpel. Some of you may have seen me over the last, I started adding up 12 and a half years now that I've been working with state and local government employees on their retirement benefits. I work for Nationwide. Nationwide is the record keeper for your Hoosier Start plan, which is why I have a position here. And I am an educator. I provide retirement education and individual retirement counseling for folks in state and local government. So we're going to spend a few minutes this morning on your Hoosier Start plan. Lisa and I have worked together for a long time to separate the differences and also encourage you to think about how they work together to help you get retirement ready. So there's certainly no competition between the two of us. We are a team to help you get retirement ready. But the state provides you, in addition to the NPERS benefits that Lisa talked about, the state also provides you a Hoosier Start plan. Hoosier Start is just a fancy nickname for what the state calls a 457B. That is the IRS code that governs this particular plan. Again, Nationwide is the record keeper, so you may see that on a statement. You may also see 457 on your pay stub. It's also referred to as deferred compensation, so why not have two DC acronyms? But you'll see deferred compensation on your pay stub if you are contributing or participating in this particular plan. If you do not see deferred compensation or 457 on your pay stub, that means you are not participating, in which case you may not be receiving the match that we'll talk about shortly. Okay, so let's jump in and talk about a few things. Again, you'll see Nationwide on your statements, but again, we are simply the record keeper for this plan. And I've always started my presentations with the idea that I'd like for you to think about retirement planning a little bit differently. So before we jump into the details of Hoosier Start, I would offer to you that when you think about retirement, a lot of people think in terms of how much money do you have in accounts? Or if you Google that, you will see how much do I need for retirement? I've seen $1 million, I've seen $2 million, I've seen some factor of your salary. I would ask you to think about it in terms of how are you going to replace your income when you're no longer working? So you all come to work, you get a biweekly paycheck, it goes into your account. We typically do that for decades. And then at some point in the future, those biweekly paychecks stop being deposited into your account, but you still have bills and expenses to pay. So instead of thinking about how much money you need to have sitting in accounts, let's work backwards and think about the types of income that you might have. That could come from Social Security, That could come from an NPERS benefit that you have vested for. And then it can also come from personal savings. And that can be your Hoosier Start account through the state. That could also be IRAs that you own or other 401ks that you participate in or have in the past or will in the future. So Hoosier Start is the account that the state offers for you so that you can set aside money in addition to what NPERS is being funded by with the state. So let me clarify that again. Everything that Lisa talked to you about, other than any voluntary contributions to NPERS, are paid by the state. The Hoosier Start account is your opportunity to put money aside out of your paycheck to fund that personal savings piece so that you have flexibility and freedom in retirement. If you are more familiar or have friends or family that have 401k, the 457 is just a different IRS code reserved for government and municipal employees. The primary difference is on the left in the middle where it says access. If you were to leave your employer before 59 and a half and had to access these dollars, you would not pay a 10% penalty to access them. Ideally, as a retirement specialist, we want you to save these dollars for retirement. But if you separate from your employer and find yourself in a situation where you have to access these dollars, you may have applicable taxes, but you would not pay the 10% penalty for early withdrawal. There are a few things about Hoosier Start that are near and dear to my heart. First of which, you can save two ways. You can save on a pre-tax basis. That is the more traditional way to save for retirement. That means that any money that you set aside in your account has not yet been taxed, and it is deducted from your taxable income in the year that you make the contribution. When you make the withdrawal from any pre-tax contributions and or any growth that you have experienced, then you will be responsible for any taxes that are due at that time. And it would be at whatever tax rate is applicable by law when you make the deduction or with the withdrawal from the account. You also have the option to contribute on a Roth basis. Roth is different than post-tax in that your contributions are deducted from your payroll on a post-tax basis, but any earnings or growth that you have on the account, when you take those out, are tax-free. So that's a little different than a traditional way of saving. It's also different than the post-tax contribution. You have contribution limits in the 2024 calendar year of up to $23,000 a year if you are under 50, up to $30,500 if you are over 50. If you happen to be within 3 years of being eligible for a normal retirement benefit and you want to go over the $30,500 limit, there are some additional contribution options, but I would want to talk about that on a one-on-one basis, and we don't want to go into too much detail today. We want to give you a lot of high-level information and then offer you the opportunity to schedule some time to meet with one or both of us to get more information. But regardless of household income or filing status, you can contribute to the before tax or the Roth option. I also want to make note that you can change your contributions to Hoosier Start anytime throughout the year. So as we approach open enrollment for the year, I want to make sure that we're clear. This is a huge misconception in the field that once you make an election, you're stuck with it until the following year. And that's not true. You can change your contribution to Hoosier Start anytime throughout the year. And you can do so online or by phone. We also have a form, but in this day and age, phone or online changes are the easiest to make and usually take effect within a paycheck or two after you make that change. There is a fee to have Hoosier Start. That fee is negotiated between my company and the Comptroller of State's office. The current annual fee for Hoosier Start is $54. That is $13.50 per quarter. And that is deducted directly from your Hoosier Start account. That does not come out of your paycheck, and it does not come out of your bank account. That comes directly out of your Hoosier Start account. If you are not currently participating in Hoosier Start and plan to, the first 2 quarters that you own the account, there is no fee. The state picks that up as a new enrollee so that you have time to get the balance built up over the first 2 quarters before you see the first $13.50 fee come out of the account. If you have other outside retirement accounts from previous employers, 401ks, 403bs, traditional IRAs, and you would like to consolidate those into Hoosier Start, you are welcome to do so. I am a salaried employee and proud to be, so whatever decisions you make based on the information that you've heard or talked about has no impact on me whatsoever. So whether you choose to roll over those accounts or not is entirely up to you. There is never a time frame on our end as to when you need to do that. There is never a fee on our end for you to consolidate those accounts. I'm happy to help you with those if you have questions on the logistics of how to do that. I also have a dedicated team by phone that can help initiate those rollovers and make those a little bit easier if we need to. There can be some benefits to consolidating. That could also include, as Lisa mentioned, your defined contribution account with NPERS. If you are separating from the state and do not have an option or have not decided what to do with your defined contribution account, you can roll that to Hoosier Start, and that minimizes the number of accounts that you have to be responsible for. Again, that's not a definite. Lisa mentioned that you have several options with your NPERS account, but if you would like to consolidate those when you separate, you are welcome to do that. We have a full team of retirement specialists. They are very small. They're in the middle. Myself and Patrick Ballard are here today. Patrick's at the table to answer any questions that you may have until early this afternoon. We also have Mark Gregoire on the left of your screen. Mark Gregoire is a personal retirement consultant. So if you find yourself in a situation where you feel like you have a more complex retirement household or situation that we need to take a deeper dive into, we have some additional resources in Mark that you can use. Generally, we can field a lot of your questions and concerns with a one-on-one appointment with one of our retirement specialists, but we do have additional resources in Mark that we can tap if we need to. There is never a fee to meet with myself or any of my team or with Mark. So I encourage all of you to take full advantage of the resources that you have available through the state as unbiased resources to help you be retirement ready. I'll highlight again, Lisa mentioned earlier that you want to make sure that you have beneficiaries designated on your NPERS account. I'm going to highlight that again for Hoosier Start. And I want to highlight the fact that we do not talk to each other electronically. We spend an awful lot of time together educating folks and members on their retirement benefits, but electronically, we do not share beneficiary information. So if you list your beneficiaries for NPERS, Hoosier Start will not know that, and vice versa. I also want to highlight that if you have added beneficiaries for PeopleSoft, for life insurance or other state benefits, listing your beneficiaries in PeopleSoft does not carry to NPERS, and it does not carry to Hoosier Start. So you truly have 3 organizations or 3 steps that you need to take to make sure that your beneficiaries are listed correctly. I'm more than happy to help you do that. You can go through the QR code, or when you register online for your Hoosier Start account, there is a beneficiaries tab, and I am more than happy to send you an email with more detail if you need some help with that. But please make sure that they are listed in all 3 places. I'm going to pass it back to Lisa for a few minutes on the retiree medical benefits account, but we'll be available afterwards for any questions that you have. Thank you very much.
That's great. Thanks, Kim. Okay, so I'm going to go through the information about the retiree medical benefits account, and then once we conclude, I'm going to circle back and go over the hybrid retirement plan information again so that our virtual audience can hear that, as we had some technical difficulties in the beginning. So I'm going to circle back and talk about that, and you are perfectly welcome to stay and hear it again. Or if you have questions, feel free to step outside to our table. Christine is at the NPERS table, and Kim will be at the Hoosier Start table, and we can address your questions there as well. Okay? So let me tell you about the retiree medical benefits account, because eligible state employees, as long as you're full-time employed and benefits eligible, you are automatically enrolled into this. So it's something that you might not even be aware of or might not be thinking about, because it's not something that you will see, but it is something that is available for you. The state established this account for members to be able to have some savings to use in retirement to pay for insurance premiums or health insurance premiums. So it is a benefit to retired employees who are eligible for a normal, unreduced retirement or disability retirement on their last day of work in a covered position. And so members of whichever plan you're in, the hybrid or the My Choice, are automatically participating in the retiree medical benefits account. We call it RIMBA for short. So if you hear someone say RIMBA, it's not the dance. We're referring to the plan, okay? And so the state funds these contributions annually that are contributed to each individual employee's account. They're contributed again annually at the end of the fiscal year. And the amount that is contributed depends upon your age, which is shown here. So if you're less than 30 years, you receive an annual contribution of $500. If you're between 30 and 40, $800. If you're between 40 and 50, you receive $1,100. And if you're 50 and over, you receive a $1,400 contribution to the account, okay? And you have to be employed as of December 31st of the prior year in order to receive the contribution. Again, the premiums or the amount that is saved within the account is used to pay for health insurance premiums at the time or during and throughout retirement. And their contributions or the balance is passed on to a surviving spouse in the event that the member passes away, so that the balance can continue to be used even after the member is passed. So it's used to reimburse your premiums and your health insurance expenses. So there is a handbook available for you to get specific details about the retiree medical benefits account. It's right there on our website at npers.in.gov. You can find the information there. Know that you're enrolled in the plan as you are working in a covered position with the state. If you leave your covered employment and go to work somewhere else, you lose that balance unless you are eligible to retire at the time that you left your position. Okay, so be aware that's a very important detail. If you return to state employment later on and you were not eligible for retirement when you had left before, you'll be enrolled in the plan again, but you'll be starting over. Okay, so that balance would not be restored. So keep this in mind. Besides the handbook, on our website, there's a specific area that you can also go to in order to get access to your RIMBA account and see what the balance is. So if you go to the retiree medical benefits area on our website, you'll get the handbook as well as the information on how to log in and have a look at the balance that you have. Okay? All right, so I know that's a lot of information all in a short period of time, but I still want to direct you to where you get more information. So what's next? So as Kim mentioned, we encourage you to go to each of our sites, log into your accounts, have a look at them, make sure your beneficiaries and addresses are updated, and then take advantage of all the other resources that are there. We have tools and calculators and all sorts of different things available to help you along your retirement journey. The QR codes are really helpful to get to it, or you can specifically just go to our websites, which are available through state personnel, as well as on all those statements that we like to send you. These are a list of the additional presentations that we're going to be providing every Wednesday this month. So again, today we went over back to basics so that you can understand the plans that you have and all the details surrounding them. And the following weeks, we're going to address other different life planning and retirement planning aspects, such as navigating life events, caregiving, maximizing your peak earning years, and then planning your exit strategy. Things to think about as you decide to retire from your covered position. So I encourage you to come back, tune in with us at that time. We'll be happy to provide you with tools and resources and information as we celebrate National Retirement Security Month. As I mentioned before, if you have questions about our presentation, Christine and Kim are outside and can answer your questions. I'm going to circle back to the beginning of this presentation and go over the hybrid plan for our virtual listeners. And if you would like to hear that again and want to get a refresher or learn the information once more, then I encourage you to stay and listen. Okay? Thank you. All right, so I'm going to back up here to our hybrid plan and make sure that our virtual audience gets the information. Okay. Are you guys ready? You good? Okay. All right. Thank you. I'll let these folks get through. Thanks for coming. Thank you. Okay, wonderful. Thank you for staying with us. I'm happy to provide you with the information about the hybrid retirement plan so you fully understand the details surrounding the plan and how you can take full advantage of it and understand how it actually works. So I'm going to move ahead to the hybrid plan area and give you the details. So the hybrid plan is made up of two parts. It's got a defined contribution and it also has a defined benefit. So at retirement, you need to decide what to do with each part. If you participate in the hybrid plan, you have both pieces. And this particular plan has been around since we were started in the 1940s. If you've been in state employment prior to 2013, this is the plan that you would be enrolled in. If you came into state employment after 2013, you'd have a choice of the hybrid plan or the My Choice plan that we talked about earlier. The hybrid plan is the default plan. So if you were hired after 2013 and given a choice of two plans, if you did not make a choice to the My Choice plan, then you would have the hybrid plan. If you're unsure of which plan you're in, I encourage you to get in touch with us or log into your account and you can have a look and see which plan you're participating in. All right, so two pieces of the hybrid plan. The first one we're going to talk about is the defined contribution account. And we call this DC for short. It's made up of a 3% contribution that the state fully funds for you. So 3% of your salary is contributed to the defined contribution plan each pay period. That money entirely belongs to you. So you don't put anything into this. The state puts the contribution into it for you. And you control the investments that those contributions go into. So we'll talk about asset allocation here in a moment, but you personalize your asset allocation as well as your beneficiaries. So you select the beneficiaries for this plan. So in case something happens to you, the benefits or the amount that you have there are paid out to whomever you'd like. There are no loans or hardship withdrawals available from this while you're working. So the defined contribution account, it's also the thing that you see on the quarterly statements that we send you. So that dollar balance that you have there represents just your defined contribution account. And it's also the balance you see when you log into your account at myimpersretirement.org. The defined benefit is the other piece of the hybrid plan. We call it DB or pension. So you may see the name interchange, but it refers to the piece of the plan that provides a guaranteed lifetime monthly benefit for you when you retire. This is also fully funded by the state, so it does not require any contribution directly from you. The amount that you receive from this pension is based upon your age, your years of service, your 5 highest salaries, as well as the option that you choose at retirement. So all those things will influence the amount that you receive from the pension. In order to receive a pension, you must have a minimum of 10 years participation in the plan. 10 years gets you vested or entitled to a lifetime monthly benefit at the time you retire. So at the bottom of the slide here, I've got some information on the calculation for your pension benefit. If you want to quickly write it up or work out the calculation on your own by hand, you can do that by taking the average of your 5 highest salaries over the course of your participation in the plan, and you multiply that by your years of service working, your years of creditable service. Multiply that by 1.1%, and that provides for you an annual amount that this pension could pay you under what's called the 5-year guaranteed income option. And that provides you with a lifetime income. So you're paid monthly for the rest of your life. And it has a beneficiary on it for the first 5 years of retirement as a 5-year guarantee to pay to a beneficiary in the event you pass away in the first 5 years. So know that there are other income options for you to choose from at the time that you retire. But in order to, if you do this calculation, it'll provide for you an estimate on income under the 5-year guarantee option. We'll talk about the other options that are available to you as well in just a moment. But know that 10 years of service gets you vested so that you can receive a guaranteed lifetime benefit at retirement. All right. In addition to retirement benefits, the hybrid plan also provides some pre-retirement benefits in the way of disability as well as survivor benefits before retirement. So if you become disabled, you're unable to continue working, whether you're sick or injured, you're unable to continue working in your covered position because of your injury or illness, as long as you have at least 5 years of service and you've been deemed disabled by the Social Security Administration, then you can apply for disability benefits to be paid to you from your hybrid retirement plan. Those benefits would continue to be paid to you for as long as your disability continues to exist. So if you find that you are in a situation such as that, you have at least 5 years of service, you've been deemed disabled by the Social Security Administration, please get in touch with us so that we can help you through the application process to ensure that you receive the benefits. Also, there are survivor benefits before retirement, because we do have members that unfortunately pass away before they have the opportunity to retire and receive their hard-earned benefits. As long as the member has 10 years of service when they pass away, then these benefits will be paid to a surviving spouse or a dependent child in the event that the member dies before retiring. So just be aware that this plan also provides for some pre-retirement benefits as well. All right, so I mentioned before, you need at least 10 years of service in order to be entitled to a lifetime benefit from the hybrid plan. To receive those benefits, you also have to qualify by age. So as long as you've got at least 10 years of service and you're 65, you're eligible for a full retirement benefit from the plan. And you can qualify sooner if you work longer. So if you have 15 years of service and you're at least age 60, you may also qualify for full retirement benefits from the plan. And then we have the rule of 85. As long as you're at least age 55 and your age plus your years of service total 85 or more, you're also eligible for a full retirement benefit. So these are the ways in which you qualify for full benefits based on age and years of service. I've got a few examples of the rule of 85 there so you can see what that could potentially pay you as long as you're at least 55, your age plus your years add up to 85. You can take advantage of rule of 85 retirement. Then there's early retirement with a reduced pension. And this is for our members who are between the ages of 50 and 59, who have at least 15 years of service. You can choose to stop working and begin your benefits early. Just know that the benefit is one that is reduced, and it stays reduced for as long as you continue to receive it. There's a few examples that are shown here. If you happen to be age 50 with 15 years, and you stop working and you choose to start your benefits early. If you do that, you'll receive 89% of the benefit, I'm sorry, not 89, 44% of the benefit you would have had you waited until your 60th birthday. If you are 59 with 15 years of service and you choose to retire early, you'll receive 89% of the benefit that you would have had you waited until your 60th birthday when you'd be eligible for a full benefit. So know that early retirement is available for you. It's just that it is a reduced benefit and it remains reduced once you start it. Now, it could be a situation where you have 15 years and you're in your 50s and you decide to stop working in your covered position and do something else. Go to work for another organization or pursue some other interest. You're not required to start in early retirement. You can certainly wait until you are older at age 60 when you qualify for a full retirement benefit. At that time, you would contact INPERS in order to submit your retirement application and get your benefits started. So if you should happen to leave your position, regardless of what age, be sure that you keep your address and information updated with us so that we can continue to contact you with your statements and other information surrounding your account. Okay, a few other things about the hybrid plan that I want to make you aware of. So it is possible to retire, but still work in your covered position at the same time. These are two examples. There is the Millie Morgan retirement, and that is available for our members who are at least age 65 and have 20 or more years of service. You can choose to retire and start to receive your benefits, but continue to work in your covered position. So that's something that you can certainly take advantage of. Also, there is an elected official retirement, and that is for members who are at least age 55 with 20 or more years of service. They can choose to start their retirement benefits and maintain their elected position. So these are two unique ways to retire, but continue to work in covered positions at the same time. As I mentioned before, we looked at the retirement calculation, and that was specifically for a 5-year guaranteed lifetime payment. Pays you for your lifetime as a beneficiary for the first 5 years of retirement. There are other choices that you have available to you at the time that you retire for your pension. There's a straight life that pays just you for your lifetime and it stops at your death. There is the 5-year guarantee that we talked about earlier that pays you for your life with a beneficiary for the first 5 years. And then there are also survivorship options that you can take advantage of. Survivorship would pay income to you for your lifetime, and then when you pass away, it would pay your named survivor, which is one person that would receive a lifetime benefit after your death. So there are many options for you to choose from. If you'd like to take a closer look at them with regard to your own individual account, I encourage you to log in to your account at myimpersretirement.org and do a benefit estimate. And this will provide for you the different amounts of benefit that you can receive from each of those options at the time that you retire. The defined contribution account, as I mentioned before, that's a balance that you're creating there over time. 3% of contribution is being made to that, 3% of your salary each pay period that the state fully funds for you. So at retirement, you've got a cash balance there that you get to decide what it is you'd like to do with. So you've got choices there as well. So you can choose to purchase a lifetime annuity. That would pay you monthly for your lifetime, just like a pension would. There's also the lump sum withdrawal. So you can withdraw the entire amount at once, or you can withdraw partial amounts. There's also a rollover. So as Kim mentioned before, you could certainly roll this money over to a qualified plan at Hoosier Start or any qualified plan that you choose, whether that be an IRA at your bank or at another financial organization. Or you can choose what's called a systematic withdrawal. And that's where you tell us how much you'd like to receive over a period of time. And you have the ability to change that amount or period as time goes on. So it's very flexible. So you've got all of these options available to you at retirement with your hybrid retirement plan. Besides that, you may also take advantage of withdrawals from your defined contribution account while you're working, as long as you're at least age 59 and a half, and you're eligible for retirement, but you're still working in your covered position, you do have access to withdraw money from your defined contribution account. Just know that taxes will be withheld and due on the amount that you receive, and it will reduce your balance that you have in your account at that time. So know that if you qualify, you may certainly withdraw from your defined contribution account. All right, that is the hybrid plan in a nutshell. I encourage you to check out our website at npers.in.gov. Have a look at the handbook for the hybrid plan, if that's the one you're in, or the My Choice, if that's applicable to you, and get further details, as this was a pretty high-level view. But again, I encourage you to come back and see us next Wednesday for more information. Thank you so much.